The Hong Kong Trade Development Council export forecast for 2010 is predicting a year of uncertainties and challenges for Hong Kong exporters. As the global economy continues to recover, a moderate 5% rise in exports is likely. But the outlook for Hong Kong's traditional markets will continue to be bleak, with high government debt and unemployment in places like the US and Europe. Buyers there are expected to continue trading down in favor of better value for items like clothing and toys, but sales of luxury items will remain sluggish. Electronics should prove to be one bright spot for Hong Kong exporters.
Throughout the years, consumers have already restrained from buying lots of electronic products, and right now there are lots of new models rolling out, and also computer upgrading will be faster next year. So we think electronic sales will be outperforming other products.
The HKTDC research also indicates that with low interest rates worldwide, excess liquidity should continue to prop up asset prices, leading to a rebound in consumer and business confidence in some markets. Already, Australia and Norway have started to see interest rates rise, but recovery has yet to stabilize in traditional markets such as Europe, America, and Japan, where interest rates could stay low for the foreseeable future.
If they withdraw their policy support so soon, then there may be a risk of a double-digit recession. But if they withdraw their policy support too late, then there may be a market bubbles and will jeopardize the macroeconomic stability.
China should continue to drive global economic recovery, with the Chinese central government staying the course on pro-growth policies. The research points out that in the first 10 months of 2009, retail sales in China increased 15%, but appreciation of the Chinese currency is expected to keep pushing up production costs.
Because most of Hong Kong companies have their production facilities across the border, the movement of the renminbi will have an impact on them. Particularly in recent years, the local contents of Hong Kong's products on the Chinese mainland have been increasing continuously because of the continued upgrading of the mainland supply chain. So any increase in exchange rate of the renminbi will have more substantial impact on Hong Kong exporters compared with the last few years.
And as economic conditions continue to improve for China's inner provinces, workers will be less likely to gravitate back to factories in the Pearl River Delta. That will also mean Hong Kong exporters must brace for higher labor costs. The HKTDC research also warns about increased protectionism as cooperation, which prevailed at the start of the global economic crisis, gives way to a return to local politics.
If China's economy continue to surge ahead, and also its export continue to rebound, then there is a high possibility that protectionist sentiments against Chinese products will increase.
The HKTDC report says Hong Kong exporters will have to work harder to understand consumer needs, as buyers will continue to be cautious even as economic conditions improve in 2010.
Because consumers still stick to the discounters and the mass merchandiser because they are looking for low-price products. So Hong Kong companies need to continue to make closer relations with this mass merchandiser and discounters so as to do more business.